Hello and welcome to this program from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts. Today we are talking to Roddy Snell, manager of the Baillie Gifford Pacific Horizon Investment Trust. So the trust returned to growth last year, but again you did lag your benchmark index. How would you sum up the year in retrospect?
Sure, look, it was a very volatile year, but look, despite the huge amounts of negative news flow, including major Chinese macro concerns, Trump and tariffs, the US dollar rising to new highs, Asia actually performed pretty well. Not far off plus 15% in sterling terms for the whole year, which, given these major headwinds, I think is quite impressive. That said, fortunes really were very divergent across the region, with the standout market being Taiwan, up nearly 40%, as we saw a rebound in the tech hardware cycle, really driven to a large degree by demand from AI, which has resulted in large cap companies like TSMC rising more than 70%. So that became almost a $1 trillion company. I think it's also worth mentioning China, which, despite the sort of terrible headlines, was actually also very strong, up more than 20%, outpacing countries like India, aided really by very low valuations and a significant shift by the government to start supporting the economy. Conversely, places like South Korea had a pretty terrible year, down nearly 20%, as index heavyweights like Samsung really struggled to maintain their leadership in the AI space. Now, as you rightly mentioned, our performance was disappointing. We're probably about 4 percentage points or so behind the index, which was really led by our holdings in South Korea, where we were overweight, and some poor stock selection in China. So, although our longer term numbers remain pretty good, clearly performance was unsatisfying. But we do remain focused very much on growth companies, and we've been adding to growthier names in the portfolio over the year, especially to what we tend to term as rapid growth names, in particular internet and platform businesses. And we've added a little bit of gearing, which I think is a clear sign that we are finding real value in Asia, and are excited about the upcoming opportunities and outlook for the region as a whole.
Okay, so all sorts going on in Asia, it sounds like. I mean, yeah, we covered you underperformed a bit, but I suppose, do you see 2024 as a bit of a turning point for the trust and maybe the wider region?
And I think it's an interesting question. I think timing turning points precisely is always quite risky, but yes, potentially I do see this as a turning point. As we discussed, Asia has actually performed very well in the face of some major headwinds, not least the strongest dollar in 4 decades, and major issues with the Chinese economy and their property market. Now, if this had happened at any other time in the past 30 years, the current dollar strength alone would have caused a full-on Asian financial crisis. But actually, there's been no crisis. Asia's actually performed okay, up about 15% last year. And as we've discussed in previous webinars, this is because Asian fundamentals and the macro are actually very solid, especially compared to the West. We've had no inflation, we've got sensible real interest rates, no quantitative easing, valuations at record lows with faster growth than the West. But despite these strong fundamentals, Asia has been held up by 2 or 3 major headwinds. I'd say China, global growth, and the US dollar. And potentially we're at an inflection point where, for the first time in years, we start to see some tailwinds. And when you think where valuations are, remember Asia's had net outflows for a decade, that could be really very exciting. And those key changes are, China clearly moving to support and stimulate their economy, which is a huge shift for the region. The US is now going through growth, deregulating and cutting rates. And finally, the dollar remains very strong for now, but it is at the highest it has been for 4 decades, at a time when the US was spending more, there'll be rising deficits, and they want a US dollar if they're going to reindustrialize. So a lot of pressure potentially coming for the dollar, and if that were to weaken, that would be a huge catalyst for Asia. So I'd summarize by saying that Asia has been a coiled spring for a while, waiting for some headwinds to become tailwinds, and with China stimulating, the US stimulating, and the potential peaking of the US dollar, this could really be really be Asia's growth moment, and it is how we are positioned.
Okay, so you mentioned some macro headwinds there, such as the very strong dollar. But I suppose what do you see as the main drivers for Pacific Horizon's underperformance, specifically last year?
Sure. So the biggest detractor last year really was from our positioning between the two largest semiconductor players in Asia, TSMC, the chip maker, and Samsung Electronics, the leader in computer memory. Now, we were significantly overweight Samsung Electronics, and although adding throughout the year underweight TSMC, which was really the wrong way on. Samsung's share price fell about 40% in dollar terms as it struggled to catch up with its main rival in the high bandwidth memory. While TSMC had a very strong year, driven by high-end chip demand, and was up about 70%. So those two companies being effectively the wrong way on, that cost us more than 400 basis points in performance. And then finally, if we look at countries, stock selection in China was our biggest weakness. We have been adding to China significantly over the past 18 months. However, it has mainly been into non-state-owned technology companies. And a lot of the strong performance in China last year came from the state-owned sector, including areas like the banks, where we have been significantly underweight. So really to summarize, Samsung and TSMC led to significant underperformance in Taiwan and South Korea, and by country, stock selected in China led us down.
Yeah, quite remarkable that those TSMC so important. Those two positions, getting them slightly wrong could cost you 400 basis points of performance. Yeah, a difficult environment. What about the main high points for the trust? What went well in 2024?
Sure. So, starting by country, despite trimming back a lot in China, a lot in India, stock selection in India continued to be the top contributor, with returns particularly strong in the small and mid cap sector, which was very strong in the country. So, standout performers were businesses like PB Fintech, which is the country's leading price comparison site, where it's disrupting a lot of sectors, especially the insurance sector, and the stock price was up more than 150% over the course of the year. And our Indian property names are also very strong as the property market continues its upcycle. So this meant by sector, property was our biggest contributor to performance. Then elsewhere, Vietnam, which is the trust's largest overweight position, about 10%, that was our second best performer. The country's macro continues to be strong, supported by exports and GDP growth of more than 70%, and a rebound in the property market, and the banks looking like they're better placed. So a number of our companies, ranging from IT outsourcers to the banks in Vietnam, were very strong. And then finally, by stock, C was by far our best performing company, up over 160%. This is ASEAN's leading e-commerce, gaming, and fintech business. And it was quite a pivotal year for the company, where they really started to prove that their business model works. E-commerce, which is I suppose, the key long-term driver, has turned profitable in the key ASEAN market. And that had always been our big question. They do very low ticket items, so a typical delivery basket is less than $5. And the question had been, well, can they make this profitable? Yes, it appears to be. So that looks like they'll be making quite significant money over the next few years, which is pretty exciting, and that's one of our top 5 positions.
Okay, great. Just kind of following up on some of what you've mentioned already, you seem to be playing the AI theme strongly. You've added a lot to TSMC. You own the Korean chip makers. Can you explain a little bit more what's behind these purchases?
Sure. Well, I wouldn't just say it's an AI theme. AI has been a strong driver for semis, but is one of many long-term drivers from the Internet of Things, autonomous vehicles, and digitization, all of which are driving a long-term secular growth in demand. So where we've been adding, in Korea, it's been to Samsung Electronics and Hynix, which are the number 1 and number 2 computer memory makers, so NAND and DRAM. And essentially, we see very strong demand for memory over the next decade, combined with these being great businesses that make 20% plus ROEs on average through the cycle. So we added to Hynix in part because it's taken a lead in high bandwidth memory, which is more in high-end applications used for AI. We also own some of it through SK Square, which is a Korean holding company where all the value is effectively in Hynix, but it's on about a 60 or 70% discount to NAV. So we think there's a lot of potential value there. Samsung, this is the number one player in computer memory. As mentioned, clearly had a very bad year operationally, fell behind Hynix in high bandwidth memory. But longer term, this is the world's biggest memory company. They're able to invest $40 billion plus a year in R&D capex. So we think these issues are temporary and it will catch up. So it's a rare opportunity to own this business below a price to book with about a quarter of the market cap in cash. So have been adding. And then the final area has been TSMC. Obviously, we haven't owned enough of this, but it is now about 11% of the trust. This is the world's number one foundry. It's got a monopoly in high-end chips. And to give an example, when I was in Taiwan last year speaking to equipment suppliers to TSMC and customers, they were all very clear that TSMC's dominant position is not going to be changing for a long time. If anything, it's getting stronger. So TSMC's pricing power and margins are likely to expand, and you're going to see very strong earnings growth over the next couple of years.
Okay, semiconductors are a notoriously cyclical market. I mean, do you see signs we might be nearing the top of the cycle?
Yeah, it's an interesting question because I think you're right. Historically, this has been a very cyclical industry. But I would make a couple of observations. The first is that some companies are more cyclical than others, and actually with the very top leading players, your TSMCs and your Samsungs, arguably the right thing to do for the past 15 years has really been to ignore the cycle and just let these compound. TSMC has compounded its share price at about 25% per annum in sterling terms over the past 15 years. Secondly, some semiconductor markets have become a lot less cyclical. For example, in DRAM, Hynix and Samsung, this has changed hugely. 15 years ago, there were a dozen players involved in the market. It was an absolute bloodbath. Nearly everyone lost money. But now it's consolidated to a three-player oligopoly, and there's significantly better supply discipline. Demand is still cyclical, but through the cycle returns are much higher and the lows are lower. And then finally, look, the long-term structural demand, I think, looks better than ever. Digitalization is only set to continue with AI, data centers, etc., requiring ever more complex chips. And that's going to raise the barriers and returns will accrue to a few winning companies. So I think there are some structural issues that are worth positive, in a positive sense, that are worth highlighting. That said, you are correct. Cyclicality has not fully disappeared from this market at all, especially on the demand side, which is hard to predict. But smartphones and PCs, demand there has been looking really quite weak. So some areas where we have been trimming include selling some of our inspection equipment makers like Co-Young. These are often places where you first start to see orders getting cut when people are trying to save money. But currently very happy with what we believe are the best-in-class names in the semi space that we continue to hold.
All right. To change tack a bit, you have a quarter of the trust in China and probably plus a bit more in A shares. We had the great stimulus week in the autumn. Again, does it seem to you to be a turning point in the government's management of the economy?
Yeah, I think this is a significant change. It might not be the kind of huge QE type stimulus that we've had in the West, but the government are clearly now focused on the economy and the market, and I think we're going to see more of this throughout the year. And we saw some clear indications of this from what happened when they announced the stimulus last year. Firstly, this was broad and clearly came from the very top. I.e., this is from Xi. It is the Politburo making these calls now. And secondly, it was clearly designed in part to support the market. In terms of property, the policy has been stated as stopping the decline and return to stability, and they've been removing red lines and restrictions. They're also supporting the stock market. They're making available about 800 billion of RMB for share buybacks. To put that in perspective, that's more than all the yearly buybacks ever in China. So I think that's certainly putting a floor under the market. Now, that's not to say they're completely out of the woods. The issues in the property market are ongoing, albeit there are early signs that is stabilising, and they've started to nationalise some of the bankrupt private companies like Vanke, which I think is a promising sign. But look, given where valuations are, not a lot needs to happen here for one to make a lot of money from stocks in the market. And the final thing I'd highlight is that on the ground, China continues to do okay. GDP growing 5% plus. Plenty of companies doing very well operationally. Tech platforms, they'll be growing their earnings 15 to 20%. And many companies continue to lead the world in many areas like batteries, EVs, solar, DeepSeek that we saw come out last week. So I think there's a lot of exciting opportunities in China at the moment.
Okay. Well, whatever the Chinese government's kind of stance or whatever the mood music, we do now also have the kind of notoriously unpredictable Donald Trump factor to take into account. I mean, do you see the new US president materially affecting the Chinese stocks you have in your portfolio?
Well, look, I mean, ultimately, yes, he and the US have the potential to impact, I would say, any stock in our portfolio, not just in China. And it certainly seems clear that geopolitical tensions with the US and China will remain. I think that's the inevitable response from a superpower towards an emerging rival. And look, that does bring risks. Saw that recently with one of our private company holdings, ByteDance, which owns TikTok. And obviously there are now questions of whether they'll be able to continue operating in the US. But it does also bring opportunities, is the flip side. For example, there are clear areas where China now needs to be self-sufficient. One of the most obvious being semiconductors, where they're putting a huge amount of resources behind. So we've invested in companies like SG Micro and Synergy that are the domestic leaders in analog chips, for example. So yes, they can impact our individual holdings. I think the pressure will be kept on China. But there are also opportunities for us within that.
Okay. Can I just ask a quick follow-up? I mean, do you have any sense of what might happen with TikTok in the US, or too early to say?
I think it's probably too early to say. From their position, I think it's interesting that Trump has come out with a delay and is looking at other solutions from what the previous administration had. I think from our sort of holding perspective, the one point I would make is that we really own ByteDance for their Chinese operations. That is where they make all of their profits. TikTok in the US is actually a loss-making business. Perversely, if they got a decent valuation for that business, you might actually find that it was good for the valuations in the shorter term. But look, for us, the real value is in what they've got in China.
Vietnam appears to be, your biggest overweight in the portfolio, more or less. I think you said. Is it essentially a kind of, is it a play on companies outsourcing who are wanting to avoid US-China trade wars and moving to Vietnam instead? Is it that simple or not?
No, I think it's not quite fair. I think, Vietnam has certainly benefited from companies looking to source from outside China, but it was doing very, very well even before US-China tensions started to rise. So, this is not a short-term cyclical story of trade tensions. We invest in Vietnam because it is, I think in our mind, the best structural growth story probably in all the emerging markets. And probably mentioned this quite a few times on our previous webinars, but ultimately they have built up a fantastic export manufacturing base, utilizing their great location, young, cheap workforce, a government that can get things done, and they've made themselves an export powerhouse. And that is the way you go from an emerging country to a developed economy. It's what the Asian tigers did, and Vietnam is doing it, and it's really become the top choice for blue chip firms like Samsung to set up their manufacturing facilities. And there's a huge opportunity. China's probably got a couple of $1 trillion of low-end manufacturing that will naturally move out over the next 10 to 15 years, and Vietnam is likely to be the top choice. So look, tensions have helped accelerate some of this shift, but Vietnam is doing well really because they're doing a great job.
When you spoke to Citywire last year, you had significantly dialed back your exposure to India on valuation grounds. Is that still the same position today? Is that still your stance?
Yeah, so we've continued to reduce India. We took another 3 or 4% out since the second half of last year, and that really has been based on valuations. I think the macro looks broadly fine for the country, but the valuations still look stretched to us. And at the same time as very lofty valuations, particularly in the sort of small and mid cap sector, expectations are starting to not be met. For example, if we go back to the last quarter of last year, I'd say probably about two-thirds of companies were not meeting analyst estimates. And when you have small and mid-cap stocks on 70 times plus PE multiples, if you start to slow down and not achieve expectations, that's when you can start to lose a lot of money. So yeah, valuations still look a bit frothy to us, and we've been taking a bit more out of India over the past 4 or 5 months.
You pin your colours to the 5-year performance track record, and indeed, the trust has markedly outperformed the benchmark since the start of 2020. Are we at the start of another kind of golden 5-year period?
Sure. Look, as I've sort of said for a while, and we discussed at the start, I think the outlook for Asia really does look very good. The macro position is strong. The region has been unloved. We've had outflows for a decade, so valuations are at record lows despite strong growth. And we finally have some clear catalysts of China stimulating, the US stimulating, and finally, if the dollar starts to weaken, then Asia really should massively outperform most markets, and our portfolio with its growth bias should be well positioned for that environment.
You say you invest in growth companies, but you're also doing so at good valuations. I suppose, if they are real growth stocks, why are the valuations so low? This person asks.
Yeah, no, I suppose it's a valid point, and it's always that question of, what is the difference between in value and growth? Because we certainly don't want to be overpaying for our growth businesses. But at the moment in Asia, I suppose particularly in places like China, we seem to be offered, growth at extremely low multiples. So if you look at our portfolio, we've been adding quite a bit to rapid growth names, particularly in the tech space, where we're seeing businesses growing, very fast, but we're not having to pay up too much for them. If I look in China, for example, we invest in a company called PDD, which is an e-commerce platform using social media effectively or using social media very effectively to sell goods and targeting the sort of lower middle class mass consumption. And this is a business that grew revenues by about 65% year on year, profits 100%. It throws off cash, free cash flow conversion about 100%. Yet it's on a 7 times PE multiple. And those are the kind of valuations that we're seeing in large parts of China, but not just China. If you look at our portfolio, you'll see that one of our big active positions is actually in Kazakhstan, and that's through a company called Kaspi, which is it's a super app in the country, but they dominate the payments network. They effectively control 100% of the payments network. So everything you use to pay for stuff in the country is through Kaspi. They've got 70% market share in e-commerce, and they're the leading fintech business. So it's an incredibly powerful network that they've got across the country. Again, that's been growing earnings 20 to 30%, and you're paying a 7 or 8 times multiple for that kind of business. So it just looks to us, especially compared to, I suppose, Western markets in the US, that you're paying significantly less for similar types of growth businesses at the moment across the region, which probably tells you how unloved parts of Asia are at the moment.
Very interesting. You mentioned Pinduoduo, which I probably have mispronounced. One of our viewers asked, which other Chinese stocks do you like?
Well, I suppose quite a lot of stocks. We've got just over probably a quarter of the portfolio in the region or in the country. I suppose the areas that we've been adding to have been in the tech platforms over the past couple of years, and that's, remember, coming from a position where we are significantly underweight if you go back sort of more than 24 months in the country. So it's been businesses like PDD that we've been adding to, and Tencent, which is the leading social media and gaming business, where we've also been adding to. I suppose the other areas we've been adding to in China would be to do with that geopolitical tension and China looking desperately to be able to be self-sufficient in key raw materials. So the semiconductor side of things, with businesses like that I mentioned earlier, like Synergy or SG Micro. Those would be the two areas where we've been adding to, and we've also got a little bit in some of the material names, commodity names, particularly focused on copper, which are Chinese businesses, which is, in many ways a long-term play on the green transition, where we think copper is a key material that's undervalued on a sort of 3 or 4 year view there.
That's interesting about SG Micro. I mean, normally people are talking about, Trump and trade wars as a threat to China, but you're maybe looking at the other side of the coin, saying which companies might benefit from that dynamic.
Yeah, I mean, absolutely. You tend to find when there's bad news and people are worried, that's when you're able to find the best opportunities. And certainly, I think the trade wars that we're seeing in the country are making the Chinese state, very conscious that they need to be able to supply those raw materials and equipment for decades to come. And if you take a simple rule book of China over the past 20 years, the way to make money has historically been, or one of the key ways has been to align yourself with the state. And there are certainly a number of sectors, semiconductors being one of them, and advanced industrials, where we think there are very decent businesses where you can make money. The challenge is actually valuations. Whereas a number of those sort of private businesses on the tech platforms are, frequently on low, if not low double digit, if not single digit P multiples. Quite often those policy aligned businesses now, particularly those on the A share market, the local market, those have been trading at very high multiples, of 60, 70 times, albeit have come off. So we'd like to have more in that space, but it's just trying to find the right businesses at the right prices.
Okay. Next question. We're back onto Vietnam and its fast-growing economy. This person observes that Vietnam's a frontier market now, but in a couple of years it might join the emerging market index, which should give it a boost. It seems to be where China was, 20 or more years ago. So I suppose, they're asking, due to the concerns there are about China, I mean, why not reduce China and add more to Vietnam if it's such a great opportunity?
Yeah, it's a fair question. I suppose firstly we do have a pretty big position there already. It's off index. It's not in our index, and it's a 10% position for the trust. I think if you go back over the past 8 or 9 years, we probably had slightly more at various points, maybe up to 12 or 13%. But I suppose the issue is, we would have more if there are more investment opportunities. I suppose one of the reasons Vietnam isn't in the emerging markets index, as a frontier market, has been because of access to the market. It's typically been quite difficult to access Vietnam. Stocks haven't been very liquid, and they have foreign ownership limits, which actually makes it quite tricky to buy the companies that you want to. It's getting better. The liquidity issue is no more, I would say. It's as liquid, if not more, than places like Thailand and Indonesia. But the foreign ownership limits are still problematic. It makes it quite difficult to access the companies. And then finally, there are some great businesses in Vietnam, but the main reason we don't have more is because there aren't more businesses that we'd like to own in the country. So, as the market deepens and there are more IPOs, and various trading restrictions get relaxed, hopefully more opportunities will come up.
Okay, thanks. We have one question about the discount to net asset value, which the shares are trading at. It's about 14% at the moment. I suppose, what measures are being taken around the discount to potentially reduce that?
Sure. So we have been actively doing share buybacks. So we'll have bought back I suppose several £1 million over the past 6 or 7 months, and we are actively looking, and the board are actively looking at the best way to bring that discount in. I suppose compared to our peers, the Asian markets have been somewhat out of favour for a period of time. We would like to be, I suppose, more effective at bringing in the discount. but the market has been against us. But as I say, we have been looking to bring in the discount and have been doing buybacks, particularly increasing those over the past 2 to 3 months as the discount has continued to widen.
Okay. We've got a question here saying that the bias and the focus of the trust is about growth companies, but can this really be said of Samsung and TSMC at this stage? I think what the question's getting at there is that these are absolutely giant companies, so in a sense, for them to grow at the same rate they have, it has got harder. I suppose, how would you respond to that?
Yeah, well, I suppose a number of ways. I mean, you could look at TSMC and say, well, it's actually grown very strongly despite being a big company over the past 3 or 4 years. And if anything, I'd be saying that earnings are likely to be accelerating over the next 12 to 18 months. So this is a large cap business, yes, but it's going to be growing earnings probably at 20% or so for the next couple of years at a minimum. And also, both for Samsung, but especially TSMC, these are businesses where it is all about scale, with huge barriers to entry. And as the industry has got more and more the technology's got harder and harder, you're having to invest, 30, $40 billion a year to keep up. So effectively, what you've seen is, all the players being forced out, and the stronger have got stronger. So that means more of the industry has gone towards these businesses. So actually, it is in these cases where it's a winner takes all. Effectively, it is the big cat names that you want to be in. And I suppose finally, because you need to put so much capital in, this is one of the few industries where you can, if you are a big player throwing off cash, you can reinvest vast quantities of that at very high returns. As I say, TSMC will be making ROEs of 30 or 25, 30%, and they can reinvest billions at that rate. So growth can be sustained. And as I say, I don't think you're paying too much for that. Samsung is a slightly different beast. They haven't been growing as quickly. However, I think they have a very if they can sort out their semi side of the business, which I think they will on a 6 to 12 months view, then you should have a memory business, growing at 15 to 20%. And then they've invested over $40 billion over the past 4 or 5 years, building up the number 2 foundry market in the world. That's currently loss making. But if they can get that working, then that can be a huge profit center, combined with a consumer goods business, which again, perfectly decent, throws off cash, and they can use that to reinvest into the semi side of the business. And the interesting thing about Samsung is that it's the only company in the world that does memory, foundry, and consumer electronics. And if we start to see AI going onto edge computing, i.e., onto your smartphone, this is probably the one company in the world that can do all the semiconductors, all the memory, and all the consumer appliances for that. So I think there's a potential for some significant outsized growth at Samsung if they can get all those divisions working together.
Okay. One good follow-up question on TSMC, with it being so important to the trust, do you have concerns about China's stance towards Taiwan?
Yeah, I think that's always been one of the more recent issues with Taiwan and TSMC. I think that's partly in the price. Arguably with TSMC. If this is a US company, I think it would probably on at least double the multiple. So I think there's a discount there already. Secondly, it is a threat that we take very, very seriously. I think I've discussed before. We've looked at the chances of a sort of Chinese invasion of Taiwan. I've spoken to a lot of specialists, sort of the intelligence community and the military community about this. And the long story short, I think, is that sort of a 5-year view, such an act is very unlikely from China. Because they simply don't have the military capability to do an amphibious landing across the Taiwanese Straits, and it would be an existential threat to the CCP if they got it wrong. But yes, look, it is a longer term threat for the business. Arguably, over time, that will likely diminish as they build up fabs outside of Taiwan, which is arguably what many Western countries are asking them to do, and giving them very favourable sort of subsidies, etc., to do so. So I think a sort of the black swan event of China going into Taiwan is less likely on a 5-year view, and longer term out, Taiwan TSMC will be investing out with Taiwan, and those risks should therefore naturally come down.
Okay, thanks, Roddy. I'm really pleased we've had this topical question. With the news this week about an apparent step change in AI capability coming from China, why do you think that hasn't been reflected in an uptick in share prices in the region?
Well, I suppose firstly, because of Chinese New Year, actually, most of Asia has actually been shut
Okay.
over since the news came out. So I think that is the main reason, and we'll find out more how the markets are taking that when they all reopen in a couple of weeks' time. Secondly, I think the other point is this is all very new.
Okay.
Obviously all over the press. We've had big moves in the markets in the US with lots of shorts covering. Um, but I'd probably caution about some of the rhetoric. I think we do need to see some more data about DeepSeek and verify, some of the claims. For instance, it's clearly very good at certain very specialized tasks like maths and decoding, but because of the lack of the chips and technology they have, they've really been focusing on niche areas, but it's forfeited some of the more general tasks that you would expect AI to be good at. So when it's asked to question, or when it's asked to give answers to some of the classic AI questions, it's only about 50% accurate. So it's been described as a sort of a mixture of experts. It's really focusing on some key areas, but other areas it's not so good on. So I think also the market's probably waiting to actually get some more data and corroboration of just how it stands up to the claims that are out there so far.
Okay. Watch this space, it sounds like. Another question. To what extent do Baillie Gifford have feet in the ground in the Asia region?
Yeah, so I mean, we run the Pacific Horizon and our Asian strategy. That's part of our emerging markets team. So that's 10 full-time investors based here in Edinburgh, and we all specifically cover a region across Asia and the emerging markets, which we typically rotate every 2 to 3 years between various of the members of the team. And obviously, I'm currently covering India, for example, so I'll be out there 3 or 4 times over the course of the year. In addition, we've also got all of Baillie Gifford's global resources. So throughout the year, we've probably got about 70 investors in our various global teams looking at Asian companies throughout the year, and all of that research is published to a central research library that gets emailed out every single day. So a lot of information there. And then we also have a dedicated China team. So that's about 8 investors in it, based in Shanghai, and that was set up about 4 or 5 years ago. And that is there specifically to look really at the China A share local market. So that's our feet and sort of boots on the ground in China. So hopefully that gives a flavour of the resources that we've got to help us cover the various Asian markets.
It does. Thanks, Roddy. Given you've mentioned India, I'm going to ask a question about India I have, and then I think we're going to have 2 final audience Q&A questions. Equinox Developments in India is your largest active position, or certainly one of them. It's not a company I've seen other fund managers owning, really. What's the story there?
Yeah, so this is quite an interesting business. So this used to be a company called India Bulls Real Estate. Now, if you mention that to anyone who knows about Indian companies, it would send sort of shudders down their spines. It had terrible corporate governance, and big financial difficulties. But we actually took a holding about coming up probably 4 years ago, and that was essentially because it's become or was a big turnaround story. There's a very decent property developer called Embassy in India, and we sort of working alongside of them. We're trying to get the promoters, the old people that owned India Bulls, out of the company, and Embassy to inject their assets and essentially take over the company. So we've been working on that for about 4 years. It's taken a little bit longer than expected. The Indian legal system is certainly not the fastest in the world, but effectively you've had the old promoters now completely removed from the business. We've got Embassy who've come in. There was a big deal that we were involved with about 6 or 7 months ago, where a significant amount of capital was raised, and Blackstone were brought in as the number two shareholder. And just this week, the full merger of Embassy into that business was completed. So they're now about 40%. So Baillie Gifford, we've probably got about 10% of the company. Blackstone, a similar amount, and we've got Embassy now in as the main promoters. So I think it's a transformational story, really, with India, with completely new management, a whole lot of new assets coming in, and very much looking forward to what we and they can achieve over the next 5 years.
Okay, thank you. Last couple of questions. How long do you see the political situation in South Korea affecting markets? One viewer asks.
Yeah, I mean that was a very unexpected event.
Does it really matter to investors?
No, I don't think it probably does in the long term. I think we'll certainly see various bits of news flow, but effectively he was a lame duck leader who was pretty ineffectual and unable to get anything done. I think reputationally it's harmful to South Korea, and certainly be interesting to see how the US take that from a defensive or strategic perspective in the region. But I think the long-term impact on markets and key companies is pretty limited.
What is the likely impact on performance of your China investments from Trump tariffs? Is the question.
Firstly, it all depends on what Trump does, and that at this moment in time is not particularly clear. I think if he goes for all-out tariffs, to China and also to broader Asia, that is, 60% China, 10 to 20% other Asian countries. That will be a tough, difficult environment for Asia and the emerging markets over the next 12 to 18 months. So if he really goes for the extreme tariffs that he has mentioned, that is a significant headwind for the region, and probably quite a tough, as I say, quite a tough environment to perform in. If you look at the stock level, it's probably not where we're most exposed. Most of our companies now in China, I would say, are focused more on the domestic side of the economy, be that the internet platforms, the semiconductor names, or some of those material names. So at the stock level, I think we're less exposed, but from a macro perspective, it would certainly be quite difficult for Asia. I suppose the final point to make is that I think we're somewhat hedged in that, depending on what sort of tariffs Trump did, but if he really went and hit China hard, then actually that probably helps a number of places, particularly Vietnam. You said, is that the place where everything gets filtered through? That's not the reason why we invest in Vietnam. But if you saw a scenario where big tariffs were slapped onto China, that would probably again really accelerate people moving out of China or looking for a second source. And Vietnam, providing big tariffs don't get put on Vietnam is then probably the big beneficiary of that. So I think we're hedged to an extent, if that answers the question.
It does, yes. Okay, well, thank you very much. Right, that's all we've got time for, I'm afraid. Thank you, Roderick, for your time and insights, and thank you for watching and for your questions today. We have more sessions like this coming up, so please do keep an eye out for those if you found today useful.